I can't help but bring up a study I covered last week. There was a study done recently about long-term stock performance. I've never seen a longitudinal study like this, and it came to some rather remarkable conclusions. It looked at the entire global stock market, 64,000 stocks over a 31-year period from 1990 to 2020. I've never seen a study this big. It took years to do this, and it found that the majority of companies did not outperform Treasury bills over this time. Only a handful of stocks accounted for the bulk of the wealth creation in the stock market. Here's an example. 5 firms here, Apple, Microsoft, Amazon, Alphabet, and Tencent, which is a China company, accounted for 10.3% of the $75 trillion in global stock market net wealth created in that 31-year period. This is rather remarkable. And look at this. In this 31-year period, only 44% of U.S. stocks outperform U.S. Treasury bills. And Ben, what's remarkable is they studied 17,000 stocks in the United States, and some people wrote in and said, there's not 17,000 stocks. There's not even 5,000 stocks in the Wilshire 5,000. There isn't, because they're all gone. Right. They came and went over that 30-year period, highlighting the fact that companies come and go, and we tend to just emphasize the companies who are the winners, who keep staying in the S&P 500. But it's a rather remarkable study. I know this is tangentially related to what we're talking about, but I never failed to bring up the point that stock picking is really, really hard to do.
It's absolutely, and we've seen these lines blurring for quite some time, and I think the ETF has been the forefront of that. So certainly what Dimensional is doing and other really what I would call rules-based active or smart beta indexes, as they're sometimes called, are all trying to really find a way to gain some kind of alpha, obviously, in the market. And again, the ETFs have been at that forefront. That said, it really comes down to when an investor is looking at an ETF, a mutual fund, or whatever the structure is, it's that after-tax, after-fee performance that really matters. And if you look at the broad-based benchmarks, the S&Ps 500s, even the NASDAQ 100, certainly more recently, they're really tough to beat. Yeah. Really tough to beat, and especially over those 3, 5, and longer-term horizons. Not surprised at all to see that.
Yeah. Gerard, U.S. stocks are again outperforming. What is this, 12 years in a row, 13, something like that. A lot of investors are wondering if global diversification is still worth the effort. Now, Gerard, I know you're very big on this. You've said many times to me and on our air, global diversification is still worth the effort. Now, given plenty of U.S. stocks have global exposure already, why are you so persistent in that argument that you make about global exposure?
Well, consistent with the study that you just mentioned, and that's consistent with prior studies that find in any given year, any given time period, it's often a small number of stocks that drive the positive returns of the market. But the trick is you never know which of those stocks are going to drive those returns in advance. And it's the same at the country level. While you may have a 3 or 4 or 10-year period where one country has done well relative to others, investing is forward-looking. It's not looking in the rearview mirror. It's forward-looking. And you don't know over the next 3, 5, 10 year which country is going to provide that high level of performance. So just invest globally. Diversification is your buddy. You can get it relatively inexpensively these days with different types of investment vehicles. And it gives you access to many thousands of companies out there. And the truth is that you don't know which of those companies are going to be the winners from a price return perspective or a total return perspective in the next 5 or 10 years. But if you have a little bit of all of them, the data kind of support that on average you're going to be doing better than those that have concentrated portfolios.
Everything he's saying, he's preaching to the choir here. I'm, everything he said, I believe. Mean reversion is a powerful thing. It's about time. And yet 10, 12 years is a long time here. Is there a structural reason why U.S. stocks outperform? Does it have to do with our legal system? Does it have to do with how easy creative destruction it is to create and destroy companies here in the United States? There's got to be, I've had my own opinion, but there's got to be a structural reason this is happening to some extent.
I think
it's not all equal across, the playing field is not completely level.
Yes to all of that, I think, are all factors in why, or that might explain what's going on here. I certainly think, from a return perspective, it's also about the dollar. And obviously that's been a huge driver of the return profile for international investing. And now you just recently, obviously, we've seen the dollar rally. You've seen ETF investors come out of the market, not surprisingly, at least on the tactical positions. And that, for both equities and certainly on the fixed income side, is also another driver that is, really provides our unique position in the financial markets, given what, global investors may or may not view as the direction of the USD versus everything else. But all the other structural reasons, and I think, and then some, would apply here.
Yeah.